Capital gains is a very complex area and one that I must say that is provided by registered tax agents and accountants, and I'm not one of those. But as part of my job as a financial advisor, a lot of the advice we give does take into account a lot of taxation issues, and this is where we always work in very closely with our clients' accountants to make sure we always have things double checked and verified. For the most part, when you purchase an asset, you have a cost base, what the asset cost you, and if you've held that asset for more than 12 months and then you sell it after a 12-month period, that capital gains comes with a 50% discount. That's the general exemption. So if you've bought a share for $10 and within the 12 months you sell it for $20, that the 100% gain will be counted in your as a capital gain, and that full $10 gain will be assessed at your marginal tax rate. Whereas if you wait after the 12 months and you realise the same $10 gain, you'll only pay tax on half of that, so you get the 50% general exemption. For those in business, there are the small business CGT concessions. Now this is where things get very complex. And that's where you've got the $500,000 retirement exemption, which you actually don't need to retire to be able to utilise. There's the 15-year exemption, and that's where you've owned an asset for 15 years or more and you are essentially retiring, and that will, that gives you the option to put money into superannuation as well. So there's plenty of benefits in the small business CGT concessions, but it is a complex area of advice. So with a capital gains, let's say you've owned an asset for over 12 months, you sell it, you've got a $10 per share capital gain. You've owned it for over 12 months, so you get the 50% discount, gives you a $5 capital gain. That $5 is then added to your taxable income and taxed at your relevant marginal tax rate. I hope that helps, but speak to your accountant.